All right, let's get into it. Today, we're diving deep into a really fascinating document that presents a totally different way of looking at the US tax system. We're talking about a theory that reimagines those familiar IRS forms not as just paperwork, but as some kind of powerful financial instrument. Okay, so here's how we're going to break this all down. First, we'll look at what a tax form really is, at least according to this theory. Then, we're going to get into this core idea of the two U's. It's a little wild. From there, we'll see the playbook for how specific forms are used, understand how a tax bill is supposedly settled, and then we'll zoom out to see the whole tax system as one giant accounting game. So let's start with the basics. We all think we know what a tax form is, right? But the source material we're digging into today claims that we've really only been seeing one side of the coin. I mean, for pretty much all of us, the Form 1040 is that yearly chore of declaring our income. It's just an administrative document, a report we have to send to the government. Seems simple enough, doesn't it? Well, this is where things take a pretty sharp turn from the reality we know. The document we're looking at claims these IRS forms have a hidden nature, that they actually function in the commercial world, kind of like a check or a formal promise to pay something. According to this worldview, every single form you file with the IRS is working on two different levels. Publicly, sure, it's the tax document required by law, but commercially, it's seen as an instrument of value, something that's governed by the Uniform Commercial Code, the UCC. And this definition right here, this is the legal bedrock for the entire argument. A negotiable instrument is a serious financial tool, and the core claim of this source is that IRS forms, believe it or not, meet this exact standard. Okay, to really wrap your head around the logic here, you have to understand this fundamental distinction the document makes. It argues there isn't just one you when you're dealing with the legal and financial system. So the theory goes like this. There are two versions of you. First, you've got the living, breathing person, what it calls the living principle, the true source of credit. And then you have the artificial legal entity. Think of your name in all capital letters on official documents. That's seen as a trust created by the government, and it's the debtor in the system. Now, this role is absolutely critical to the whole theory. A fiduciary is just someone who can legally act for someone else. In this whole setup, the document argues that the living principal, that's you, can appoint a fiduciary to manage the business of that artificial debtor entity. And how do you establish this control? Well, the source points to two very specific IRS forms as the keystones. Form 56 is used to tell the IRS that a fiduciary relationship is now in place, which kind of separates the principal from the debtor. And then Form 2848, a power of attorney, gives that fiduciary the explicit authority to act. So, this brings us to the playbook itself. The theory basically reinterprets the whole purpose of several common IRS forms, looking at all of them through this commercial lens. Each form gets a new, specific commercial job. So, a Form 56 isn't just a notice anymore. It's a jurisdictional declaration. A Form 843 stops being a simple refund request and becomes a verified demand for credits. Even a Form 1041 is seen as a settlement statement. You see the pattern here. They're all framed as tools for managing a trust account, not just for filing your taxes. Which, of course, leads to a pretty big question. If this is all just a bunch of accounting, how does a tax bill ever get paid? According to this theory, the answer is hiding in plain sight, on the payment voucher that comes attached to your tax forms. Get a load of this phrase. This is presented as the magic key, the secret sauce. The document claims that by endorsing a payment voucher with this exact language, you're transforming it from a dumb slip of paper into a powerful payment instrument that actually instructs the Treasury to settle the account. So here's how the process supposedly works. Step 1, you get the bill with its voucher. Step 2, you write that specific endorsement on it. Step 3, you send it back. And step 4, the theory claims the obligation is then settled through an accounting process, not by you sending in any actual money. And the document tries to back this up by arguing that these vouchers already tick all the legal boxes for being a negotiable instrument under the UCC. I mean, they have a specific amount, they name the payer and payee, they need a signature, and their entire purpose is to settle a debt. The argument is that it fits the definition. So, okay, let's zoom out and put all these pieces together. What kind of picture does this paint of our tax system as a whole? As you can probably guess by now, it's a pretty radical one. A central pillar of this whole theory is that the IRS doesn't actually own any debt. It's not a creditor that you owe money to. No, in this view, the IRS is just a bookkeeper, basically an administrative arm of the U.S. Treasury that manages a giant ledger of debits and credits. And how are all these transactions tracked? The source describes a dual ledger system at the Treasury. You've got the individual master file, the IMF, which tracks all the standard stuff tied to your Social Security number. But then there's the non-master file, or NMF, and that's supposedly where these off-ledger fiduciary instruments get recorded. The document even gives a little lesson on double entry bookkeeping using this dealer acronym. This is all to hammer home the idea that the entire system is just a commercial accounting framework, all about balancing assets against liabilities and debits against credits. And it all comes down to this really powerful summary statement from the source. Within this framework, that voucher you send back, it's not a slip of paper that comes with your payment, it is the payment. It's an instrument that directs the settlement of an account. And there you have it. The theory completely reframes the federal tax system. It's not about collecting money from citizens. Instead, it's presented as this huge, ongoing commercial accounting operation, just reconciling instruments inside a national trust. By laying out this incredibly detailed and, let's be honest, alternative view, the source material really makes you think about that relationship between people, super complex legal systems, and the ongoing search for financial control. That's our explainer for today.